All right, welcome to The Explainer. Today we are putting on our expert investment analyst hats. We're going to put Xylem, which is this fundamentally robust global water tech giant, through an absolute gauntlet of a financial stress test to figure out its true intrinsic value. We've got the data, we've got the legendary frameworks of investing giants, and we are going to see once and for all if this stock is actually worth your hard-earned money.
Okay, here's our roadmap for today's financial audit. We'll grab a quick snapshot of the company, view it through the lenses of Warren Buffett, Peter Lynch, and Benjamin Graham, crunch the numbers with a DCF analysis, try out a couple of alternative models, and finally wrap it all up with our synthesis and final verdict. Let's get to it.
Starting right off with Section 1, let's get a snapshot of the company.
So, what exactly is Xylem? Well, they are a massive, undisputed global leader in water cycle solutions. They basically design and manufacture highly engineered products for everything from water transport and treatment to advanced smart metering. We're talking about a heavyweight with a market cap of nearly $27 billion. And to give you a sense of their momentum, they just recently secured a record-breaking $850 million outsourced services order. They are a true industry powerhouse.
But take a look at this number right here, $113.94. This is Xylem's current stock price, and it's going to be our anchor for this entire explainer. You see, as investors, our job isn't just finding great companies, it's finding great companies trading at great prices. So we're going to aggressively test this $113 price tag against some hardcore intrinsic value models to see if it actually holds water. That brings us to Section 2, evaluating the stock through the Warren Buffett lens.
If the Oracle of Omaha himself were looking at Xylem, the first thing he'd be hunting for is an impenetrable economic moat. And honestly, Xylem has built a fascinating one. As you can see from the sustainability scorecard, they aren't just pushing water pumps. They are structurally embedded in the global push for sustainability. They've got an outstanding rating for non-financial disclosure, an incredible 96% processed water recycling rate at their facilities, and validated science-based targets. In a world facing serious water scarcity, that kind of expertise isn't just nice to have, it forms a highly future-proof economic moat.
But you know Buffett, he loves a good story, but he demands pristine financials to back it up. Looking at the balance sheet data we pulled, he'd probably be grinning. Xylem delivers a really solid return on equity of 11.77% and a super healthy net margin of 11.06%. And even better, they do all of this with a highly manageable debt-to-equity ratio of just 0.29, meaning they aren't dangerously leveraging the company to artificially boost those returns.
And here is the absolute crown jewel for Buffett. Xylem generates $1.23 billion in trailing 12 months free cash flow. Actually, for Buffett, this free cash flow is basically what he calls owner earnings, the actual literal cash an owner could pull out of the business without crippling its competitive edge. So on a qualitative and fundamental level, Xylem passes the Buffett test with flying colors. But as we're about to see, the price you pay for that quality is a whole different conversation.
Let's move on to Section 3 and shift gears to the Peter Lynch and Benjamin Graham lenses.
We'll start with Benjamin Graham. And running his incredibly strict, deep value checklist is usually pretty humbling for modern stocks. Xylem actually does great at first. It easily passes his checks for adequate size, strong financial condition, earning stability, and its awesome 14-year streak of dividend increases. But Graham demands a moderate valuation. And here, Xylem completely fails due to its steep price-to-earnings multiple of 26.95. For Graham, paying almost 27 times earnings is basically a non-starter. It's just way too speculative for a defensive investor.
Let's actually do the math on that to show you what I mean. Using Graham's famous intrinsic value formula, we take the square root of 22.5, multiply that by their earnings per share of $4.20, and then multiply by their book value per share of $44.63. That formula spits out a hard, mathematically driven target price of just $64.94. Compare that to our current market price of $113.94, and wow, that signals a massive lack of margin of safety at current levels. Graham wouldn't touch this stock right now.
Okay, so what about Peter Lynch and his growth at a reasonable price philosophy? Well, Lynch would likely categorize Xylem as a dependable stalwart. That's a large, established company that won't give you wild, explosive growth, but offers solid protection during a recession. However, Lynch cares a lot about the PEG ratio. That's price to earnings divided by growth. Xylem's PEG is sitting at a lofty 1.66, which is way above the 1.0 threshold Lynch typically looks for.
Plus, with a massive 87.96% institutional ownership, this trade is already super crowded. Wall Street knows all about Xylem, so you definitely aren't sneaking in early on a hidden gem. For Lynch's style, this is probably a stock to sit out for now.
All right, into section 4. Let's do a rigorous DCF valuation analysis.
So the gurus are clearly skeptical about the price. Let's completely strip away the qualitative factors and just run a hard, discounted cash flow or DCF analysis. Now, since our sources don't project long-term cash flows beyond near-term guidance, we have to make some realistic assumptions. We'll build our base case using that $1.23 billion free cash flow as our starting line. We'll forecast that out 10 years, assuming a conservative 5% midterm growth rate and an 8.5% weighted average cost of capital, or WACC, which aligns perfectly with standard industrial sector averages. For the end of the line, we'll apply a 2% terminal growth rate, essentially assuming Xylem grows with long-term inflation.
So, when we take all those projected future cash flows and discount them back to see what they are worth in today's dollars, the math yields an estimated fair value of roughly $78 per share. There it is again. We find a number significantly south of the $113 the market is currently asking you to pay.
But hey, a good analyst always stress tests their assumptions, right? As this sensitivity table shows, we can pull the levers in our model to be a bit more optimistic. Let's say we lower the discount rate to 7.5% and raise the terminal growth rate to 2.5%. Even then, the absolute best-case DCF value maxes out around $95. The model simply struggles to justify the current trading price under literally any realistic scenario.
Moving into section 5, let's look at some alternative valuation models.
We don't want to just rely on one quantitative model. To make sure this audit is truly bulletproof, we need to apply at least 2 alternative models to the data, just in case we're missing something. We're going to use a dividend discount model, or DDM, which values the stock purely based on the present value of its future dividend payouts. Alongside that, we'll run a comparable multiples analysis, looking at how Xylem is priced relative to typical industrial sector averages, specifically focusing on its enterprise value to EBITDA of roughly 15.6 times.
Let's see what the results look like. For the DDM, using Xylem's current $1.66 dividend and assuming a standard 6% dividend growth rate, we land on a fair value of around $70. For the multiples analysis, if we assume a standard 20 times sector average PE, instead of Xylem's current lofty 27, we get a value of roughly $84. The takeaway here is absolutely crucial. No matter which mathematical angle we take, both alternative models generate fair values well below the current market price.
Finally, section 6. It's time for our synthesis and final verdict. Let's bring all these disparate numbers and investment philosophies together. This visual scorecard perfectly summarizes our entire audit. You have the current market price standing way up there at $113.94, and beneath it, a staircase of intrinsic value estimates. Graham places it at $64.94. The DCF model is around $78. The multiples analysis puts it near $84. Literally every single valuation framework we applied prices Xylem's intrinsic value way below what it costs to buy a share today.
Synthesizing the data, we're left with this undeniable tension. On the one hand, Xylem is a phenomenally high-quality company. They have an unmatched economic moat in water tech, incredible sustainability metrics, and a rock-solid return on equity that Warren Buffett would applaud all day long. But on the other hand, the stock trades at a steep premium, has a high PEG ratio, and offers absolutely zero margin of safety for the defensive investor.
Which brings us to our final verdict. While Buffett might genuinely love the underlying business of Xylem, the cold, hard math of Graham, Lynch, and our DCF models dictates a definitive hold right now. If you're looking for a target entry point where these legendary criteria might finally trigger a buy, it looks to be much closer to that $80 range. So I'll leave you with this provocative question to chew on. Is a great company always a great stock? Will you wait patiently for the market to offer a price that actually makes mathematical sense, or will you pay the premium for undeniable quality? Thanks for tuning into this explainer, and keep your pencils sharp.